Supply is under stress. Demand for physical silver is surging, and price discovery is breaking down. A reset is coming in how silver and gold, frankly, are going to be priced. Buyers are paying extra for same-day delivery because they can't afford to wait, and they don't trust that the metal's going to be there when they're ready for it.
Investors are losing confidence in general with fiat money, and so everybody is buying gold. Right? So it's not simply that people are worried about the dollar; they're worried about other currencies too.
In a recent conversation, financial experts Schiff and Lynette Zang shed light on the growing turbulence within the global precious metals market, signaling a deeper shift in how real value is perceived and measured. According to them, silver supplies are tightening amid surging global demand, while the traditional mechanisms of price discovery are beginning to falter. What may appear as a short-term trading anomaly is, in reality, an indicator of a larger systemic transformation in the world's financial structure. Today, physical gold and silver are becoming increasingly scarce, and investors are willing to pay significant premiums for same-day delivery, reflecting their growing mistrust of paper-based and digital substitutes. This urgency underscores a broader loss of faith in fiat currencies and financial institutions that rely heavily on promises rather than tangible assets. As inflation rises and central bank interventions continue to erode the purchasing power of money worldwide, the shift toward physical metals has become a global phenomenon, not just an American concern. Investors across nations are seeking security in assets they can hold in their hands, not just theoretical claims on a screen. The message Schiff and Zang emphasize is clear. The reset in gold and silver pricing has already begun. Precious metals are reclaiming their centuries-old role as true stores of value, and those who recognize the change early are positioning themselves wisely before the rest of the world catches on. For more insights and discussions on the evolving gold and silver markets, stay connected, like, share, and subscribe to the channel, and turn on notifications so you never miss an update.
It is objectively the most useful metal that exists. It has properties that no other metal has, and therefore it has more uses than any other metal on Earth. The only reason that gold is not used more often is because it's too scarce and too expensive. But it is certainly the most useful metal on the periodic table. And if you appreciate the properties that gold has that make it so unique and that make it so valuable and why it has been valued for thousands of years, right? It's not an accident that gold has been around for so long and has maintained its purchasing power over the centuries. It's not about just a irrational belief system. Gold objectively has value. You could dispute how much value, but it has value as a rare, precious metal that has properties that allow it to be utilized in so many different industries. And the fact that it's also used as money and the fact that central banks hold it as money, yes, that is yet another use for gold. But without the underlying value as a precious metal, it would have no value as money. It could not serve as a store of value if there was no underlying value that was being stored. Investors are losing confidence in general with fiat money. And so everybody is buying gold. Right? So it's not simply that people are worried about the dollar. They're worried about other currencies too. But I do believe that at some point you will start to see more pronounced dollar weakness even against other fiat currencies. In fact, in the first half of this year, the dollar dropped about 10%, and it was off to its worst annual start in like 50 years. So that's some indication that you're seeing the confidence in the dollar erode more than in other fiat currencies. But I think that by next year, you're going to see a much weaker dollar on foreign exchange markets. And so that will be happening. Now, as far as the bond market, we've already seen that. Because if you recall, the last time the Fed cut rates, and they cut rates before they started this new cycle, they cut rates by about 75 basis points, and long-term rates went in the other direction by the same amount. And very few people expected that. They thought when the Fed cut rates, bonds would rise. Instead, bonds went down. I think that was an indication of an erosion of confidence in the world, in the U.S. government's ability to repay its debts and to service its debts. So I think we've seen it in the failure of the bond market to rally. We haven't seen like a big crash in the bond market yet, but the bond market hasn't rallied the way a lot of people would have expected. And I think that's coming. So I think the people that are complacent about $4,000 gold and who think, hey, there's nothing to worry about because we haven't seen a dollar crash yet against the euro or the yen, or we haven't seen the bond market crash. Those things are going to happen. But the problem is if you wait for that, if you wait for the dollar to collapse on foreign exchange markets, if you wait for the bond market to crash, well, I mean, it's pretty much all over now, right? What are you going to do then, right? You have no time to prepare for it. You have no time to maybe adjust course and try to prevent it. It's too late, right? People should be looking at the early warning sign of the price of gold and say, wait a minute, this is a reflection of a loss of confidence. We need to act quickly before the whole thing completely implodes, which is going to happen. And the fact that nobody is heeding the warning of gold is why it's inevitable that the crisis is going to happen, because nothing is being done to try to prevent it. People who own gold as a metal, almost everybody owns some gold, right? But I'm talking about buying gold as a store of value, buying a gold coin or a gold bar, right, as an investment. And there, hardly anybody is doing that. A very small fraction of investors. I would say that probably more Americans have bought Bitcoin as an investment over the last several years than have bought gold. And it's probably not even close to in raw numbers.
In a recent discussion, renowned financial commentator Peter Schiff outlined why gold remains unparalleled among all metals, not only as a store of value, but also as one of the most practically useful materials on Earth. Schiff explained that gold's unique physical and chemical properties make it indispensable across a wide range of industries, from technology and medicine to electronics and aerospace, while it continues to uphold its historic role as money. Unlike other assets or metals, gold's value is not rooted in sentiment or tradition, but in its intrinsic utility and scarcity, qualities that no fiat currency can replicate. He further pointed out that as global confidence in paper money erodes, investors are increasingly turning toward physical gold as a safeguard against monetary instability. The US dollar's recent weakness, having fallen nearly 10% earlier this year, is a sign of deepening concern over the government's fiscal discipline and debt load. According to Schiff, the next major phase could see simultaneous declines in both bonds and the dollar, a reflection of mounting doubt in the US government's ability to sustain its obligations. He warned that those waiting for an outright dollar collapse or bond crisis will be too late to respond. The rally in gold is already serving as the market's early warning signal. Schiff concluded that now is the time to prepare, not after the storm hits. The shift toward tangible assets like gold represents a rare opportunity for those paying attention to protect their wealth before the inevitable unfolds. Let's get into the interview.
For decades, COMEX futures controlled silver's price. Paper trades suppressing real rallies because they can create as much silver and gold, for that matter, as they want to in these paper contracts if they never have to make delivery. But not anymore. Now that backwardation shows physical buyers are in charge. Real supply and demand are setting the price. And each dollar of backwardation marks a shift in power from paper speculation to physical reality. Perhaps that's why you're seeing such a big hit that just recently took place with both gold and silver, because a rising gold and silver price are an indication of a failing fiat currency. But silver is no longer just an industrial metal. It's behaving like, sound money. And the world is waking up. The squeeze is on. And the reset isn't coming. It's already begun.
Bitcoin is negatively correlated with gold. And we just had a significant correction in the price of gold. Gold went from almost 4,400 down to 3,900. So a 10% drop in the price of gold, and Bitcoin fell. It initially caught a bit of a bid when gold broke the first time, but then it lost that rally and has now surrendered the entire rally. So Bitcoin is not rising when gold goes down, but it will go down, I believe, when gold goes up. So I think the worst thing that could happen now for Bitcoin is a correction in the NASDAQ and a new high in gold. So if that happens, I think Bitcoin is going to just get demolished. We'll see how low it goes. But yes, I was wrong 10 years ago, 15 years ago, in that I didn't buy Bitcoin as a gamble, because obviously with the benefit of hindsight, the gamble paid off dramatically. I don't think I was wrong in my characterization of Bitcoin.
For decades, the COMEX futures market has played the dominant role in determining silver prices, not through genuine supply and demand, but through a web of paper contracts that seldom resulted in actual physical delivery. That system, however, is beginning to unravel. Today, a phenomenon known as backwardation, where spot prices rise above futures prices, signals a power shift. Physical buyers, not paper traders, are increasingly setting the tone of the market. Each move deeper into backwardation represents a transfer of control from speculative traders to those holding real, tangible metal. This growing demand for physical delivery is driving the current volatility in both the gold and silver markets. Historically, rising precious metal prices have always been a warning signal of distress in fiat currencies, and the same pattern is repeating now. Silver, once regarded merely as an industrial metal, is reclaiming its identity as sound money, a reliable hedge against currency devaluation and systemic instability. The ongoing squeeze in physical supply isn't a distant risk. It's already unfolding, quietly exposing the vulnerabilities of a paper-based financial system. Meanwhile, Bitcoin's shifting behavior, declining alongside gold and failing to rally when gold rises, suggests that digital assets may no longer serve as dependable safe havens. In contrast, precious metals are regaining their timeless reputation as anchors of real value. The monetary reset is no longer a speculative theory. It's happening in real time. The only question that remains is, are you positioned for what comes next? For more insights, stay connected with Noble Money. Like, share, and subscribe. And don't forget to turn on notifications to keep up with the latest updates on gold, silver, and global markets.